the problem with the indirect cash flow method that virtually everybody uses is that it's useless for the business. It's such an accountant's exercise, literally a reconciliation between net income and cash. And, and like an income statement makes intuitive sense to a business person, even if they're not an accountant. We sold some stuff, we had some costs, we got some profit. The balance sheet makes intuitive sense. We own some cash, customers owe us some money, we owe vendors some money. But, try to walk a business person through, why the increase into the deferred commissions balance is a cost to cash. The indirect method cash flow statement is useless as a business tool, which is why most businesses just consume the burn, the number at the end. And the irony, of course, is that the investing and financing sections of the indirect cash flow are done with the direct method. And those, even though they have nothing, much less to do with the business, they make perfect intuitive sense because the lines are things like, proceeds from sale of marketable securities. Everybody, that sounds like cash coming in. And so there's an irony that we all use this statement that's somewhat useless to the business. And it's like switching to the direct method really makes it a tool that, as Steph said, you end up with a forecast that people can understand and then it is actionable. If I forecasted that we're going to pay $10 million to employees and then we pay $9 million or $11 million to employees, that's a variance that everybody can immediately grok and immediately start to drill down into why and why we missed it in our forecast. And you iterate that way and get better and better. And it just makes much more sense as a business tool.